this short video, we will discuss the information ratio, how it is defined, the role of alpha, along with the advantages and disadvantages of using this metrics. The information ratio measures the efficiency of a portfolio in terms of its relationship to a benchmark. The formula quantifies the return an investor receives in exchange for risk assumed on a trade relative to another benchmark portfolio or index. For evaluation purposes, the higher the ratio, the more efficient the portfolio performance. The information ratio was created by William Sharpe as an extension to his famous Sharpe ratio. Both the risk-adjusted metrics use similar formulas, with the only difference being the numerator of the Sharpe ratio and the information ratio, which is the choice of the benchmark. The Sharpe ratio uses a risk-free asset such as treasury bills, whereas the information ratio uses a style benchmark, an equity index, or a fixed income index. So for example, the information ratio on an equity portfolio might use the S&P 500 as an index. Since treasury bills are generally passive, the information ratio gives investors value in relative performance. The information ratio uses the residual active return relative to the residual active risk. The information ratio can provide a measure of an investment manager's performance above that attributed to investment style or beta. It's how well a money manager takes advantage of the opportunities that are reflected in the marketplace. The information ratio uses the term alpha to determine the performance on a risk-adjusted basis. The alpha takes the volatility of a portfolio and compares its risk-adjusted performance to a benchmark. The excess return of the fund relative to the return of the benchmark is called the alpha. A positive alpha of 1 means that a fund has outperformed its benchmark index by 1%. Correspondingly, a negative 1 alpha would underperform by -1%. In a CAPM analysis, if the estimate of a portfolio should earn 10%, and instead it earns 15%, the alpha would be 5%. The information ratio benefits investors by comparing the portfolio to a benchmark instead of a risk-free rate of return. The excess return is divided by the standard deviation of the return of the alpha. The return measured can be of any frequency, daily, weekly, monthly, or annually, as long as they are normally distributed, and the returns can then be annualized. The disadvantage of using this ratio is similar to the disadvantages of using the Sharpe ratio in that not all asset returns are normally distributed. Anomalies like kurtosis, fatter tails, higher peaks, and skewness on the distribution can be problematic for the ratio, as the standard deviation does not have the same effectiveness when these problems exist in a distribution.